Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll break down an internal review of the IT company Supermicrocomputer.
Plus, we'll discuss how the automaker Stellantis is faring after the early departure of its CEO.
But first, we begin with a big deal in private credit.
This week, BlackRock agreed to buy HPS Investment Partners in an all-stock deal valued at roughly $12 billion.
It's a purchase that will propel the world's largest asset manager into the highest ranks of private credit.
For more, we are joined by Neil Sipes, Bloomberg Intelligence financials analyst.
We first asked Neil where exactly this purchase leaves BlackRock.
Top 5 in private credit now, and notably top 5 in alternatives as a whole. And so, they've long been top 10 in the space, rivaling the names like a Blackstone, Apollo. But when you think about BlackRock, you're thinking about $11.5 trillion in assets, a couple $100 billion in alternatives. That's a pretty small piece of the pie for them. So you don't necessarily think of them as a main leader in the alternative space and private market space. But what we've seen so far this year is 3 transactions, GIP, Preqin, and now HPS, and they're really pushing into this space because that's where the growth is and that's where the fees are.
It's just a phenomenal deal. You can do it with all stock as well. How cool is that if you're BlackRock? Who is HPS? Are they ex-Goldman guys? Is that kind of how big are they in the space?
Yeah, so they're about $150 billion now. And like you noted, BlackRock had about $80 billion in private credit prior to this. So it really more than doubles that business for them. And I think, what you're seeing a little bit at BlackRock is sort of this catch-up game. As I just noted, those 3 transactions really geared towards the private markets this year. And they're paying, heftier prices for these types of transactions. I noted this is where the growth is. This is where the fees are. The $12 billion price tag for HPS, that's about 8% of assets, 30 times, fee-related earnings. So they're sort of playing catch up in this space. And when you think about HPS, $150 billion is not small, but that's about 1% of BlackRock as a whole, right? But when you look at the fees that HPS is generating, that's almost 5% of what BlackRock's revenue is. So you can sort of think about the dichotomy there of aligning the organic growth opportunity more with the revenue opportunity.
Are there more HPSs out there?
There may be. I don't think we're going to, I won't say I don't think we're going to see BlackRock do any more because they are showing that they're taking initiative to really beef up in a space that you could argue they were a little bit under-indexed versus some of their traditional competitors in the space. So we'll be interested to see what is potentially coming down the road. But again, let's remember that they are sort of digesting a handful of transactions that are pretty sizable and what we'll call transformational for a business that you're typically thinking of sort of the index and passive type products.
At the end of the day, who competes with BlackRock, really? Aren't they just...
Well, okay, what is BlackRock government now at this point?
Yeah, what is BlackRock now at this moment?
BlackRock is, I guess, I'll say everything sort of in the asset management
So you're at dinner at Thanksgiving and someone's like, hey, what's BlackRock? And you're like, it's everything.
Yeah, it's a little bit of everything now in the asset management space. And again, I think they're really filling out that space where they were maybe least indexed to and, really focusing in on where the fees are. And that's what this private credit transaction is going to do.
So are some of the big private equity guys too, like Blackstone, et cetera, are they also just massive asset managers now too, rather than just private equity guys?
So they are, and they're sizable, and it's a different realm that we're talking about than BlackRock's 11 trillion. We're talking about single-digit trillions and high 100 billions. But again, that size is not necessarily representative of the fees that these firms are generating. So you think about the names like a Blackstone, Apollo, Ares, KKR, Carlyle, all of those as a group. That's where that explosive growth has been in asset management, aside from that passive, low fee type space, right? You're seeing those longer duration assets, those private markets really being where investors want to allocate their cash. You look at the expectations for allocations to increase pretty much broadly across the spectrum in private markets. That's where some of those, we'll call them smaller, more specialized alternative managers are winning.
Our thanks to Neil Sipes, Bloomberg Intelligence financials analyst.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance.
They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and ag sectors.
This week, we took a look at BNEF's outlook for U.S. natural gas. For more, we were joined by Enrique Gonzalez, BNEF head of U.S. gas research.
First, we asked Enrique where we stand now with gas and where the U.S. will stand under a Donald Trump administration.
The U.S. is the largest exporter of LNG in the world. And in the short term, we have a considerable amount of new capacity coming online. And that was bound to happen regardless of whether we had Trump or Kamala in office. But yeah, we have Plaquemines and the Corpus Christi Stage 3 expansions coming in this December or early next year. And then the Golden Pass LNG terminal as well. So giving us more than 7 BCFD, 7 billion cubic feet per day of new export capacity out of the U.S. So further consolidating that role. And then where the change could be more significant is in the medium term with the terminals coming later this decade. And especially with these discussions of Trump lifting the DOE non-free trade agreement permit pause. Because this is a key permit that the terminals need to be able to reach their final investment decision. And there's a few high-profile projects there, such as the CP2 expansion from Venture Global, and then we also have a Sabine Pass Corpus Christi expansion alongside other projects that are targeted for them.
So basically, if you're not exporting LNG to a free trade agreement country, then you're no longer allowed to do it. But many said that was like an export thing that they were doing that really wasn't going to hold, that it was just an election thing. So that's what we're referring to. So that would really help get a lot more investment in there.
Is the expectation in your world of natural gas that a Trump administration combined with a Republican-controlled Congress, this is going to be the time to get stuff done, whether it's a pipeline or a refinery or anything?
You know, going back to the idea of the LNG terminals, it's definitely, you have more support to get these projects done. I think moving to the idea of pipelines, interstate pipelines, that's there needs to be more change. It's a bigger conversation, but it is there's definitely more momentum than we would have otherwise had.
So to that point, and it's a good one that you make, because a lot of the gas that we have is in Appalachia, and it's really hard to get that gas out. It's in the Northeast. You don't have a lot of takeaway capacity, and you do get a ton of gas from also shale production, so within New Mexico as well as Texas. So there is that. What do you think we're going to be able to do in terms of getting pipelines in to get gas out of Appalachia?
Yeah, so I would say that's not my subject matter expertise, the policy behind the pipelines, but I think there is space to have more discussions about what can be done to get some more gas from.
But if we don't, do we wind up getting a glut at some point of gas because there's just too much and we can't get it out, therefore gas prices here in the U.S. kind of really sink?
Yeah, and when we've already seen this happen, especially this early November when the weather was pretty warm, we've seen, Appalachia can't really send more gas out. There's not internal demand in the basin. And then we've seen producers actually curtail production because the prices have dropped below the level they need to continue producing even from existing wells. And they're well below the break-evens in some cases for new wells. So we've already seen that have an impact in production in Appalachia. And as well in other parts of the country, you have the Haynesville as well, that's closer to the Gulf, and where a lot of the rhetoric is that the production to meet the demand from these new LNG terminals is going to come from there due to the location, but they do have higher break-evens and higher costs than in the Northeast.
Coal. What's going on with coal, and what do you expect under a Trump administration to happen to the coal industry in this country?
Yeah, so there's been a lot of discussion now about potentially rolling back some rules from the EPA, or just having or being easier on pollution from coal. I've seen, I think it was Duke Energy as well, discuss the possibility of keeping some of their coal plants operating for longer. So that is a possibility, and what it could mean for gas and for power sector gas consumption could be pretty interesting, because over the last 10 years, one of the main roles of gas in the power sector has also been replacing, this retiring coal plants, which has been a benefit in the sense that we've seen lower emissions as well. But this could be more difficult if the coal plants stay operating longer. You might not see gas taking over in the same way it had been.
That's interesting. That would remove this very mechanical market function, basically, for gas and coal. Is the coal, is it green coal? Is it nice coal that we can all get behind, or is it still dirty coal that eventually is just going to have to be phased out?
Yeah, and there's a lot of discussion as well about integrating carbon capture for coal, try to make it cleaner. But yeah, the economics are difficult, and especially in the short term, we probably won't see a lot of that happen. So it could result in emissions even increasing.
Is there the expectation under Trump administration that just the whole move to renewables will slow down, and maybe slow down materially, or is it just too much momentum?
Definitely parts, for example, of the Inflation Reduction Act are repealed, or there's changes in that sense. We could see slower deployment of renewables. My colleagues in BNEF, in our clean energy teams, look in a lot of detail into this. But yeah, this could lead to an interesting dynamic where you have less coal retirements, but maybe you have a slower deployment of renewables, where gas maybe doesn't grow because there's less coal, but takes over some of this generation that would be needed, that would otherwise come from renewables. So I think there's a very interesting analysis and a conversation to have about how this gap is going to look.
Our thanks to Enrique Gonzalez, BNEF head of U.S. gas research.
Coming up, we're going to break down potential scenarios related to President-elect Donald Trump's proposed tariffs.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. You can access Bloomberg Intelligence via BI Go in the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
We begin in the tech space with the IT company Super Microcomputer.
This week, shares of Supermicro jumped after the company said an independent review of its business found no evidence of misconduct.
However, the review did recommend the appointment of new top financial and legal leadership, including a new CFO, Chief Compliance Officer, and General Counsel.
For
more, we were joined by Jin Ho, Bloomberg Intelligence Senior Technology Analyst.
We first asked Jin to remind us what the problem is that Supermicro has been trying to correct.
A couple of things. There was a short seller report back in August citing that there was some fraud, internally, and essentially because of that, there was an internal investigation, and they delayed their 10K and 10Q filings. What Supermicro is essentially saying, their internal investigation has found nothing or no evidence of fraud, but the 10K and 10Q filings still have yet to be filed.
But it's not every day that a Big Four accounting firm does what happened here. Basically says, they really can't rely upon the management team, and they just walk away from an account. That doesn't happen very often. No, Paul, I think between your lifetime and my lifetime in the financial industry, probably 4 or 5 times, right? So it doesn't happen. It doesn't happen. They did find an alternative. BDO USA, and quite frankly, with the special investigation, being completed without evidence of fraud, it actually almost gives them BDO a safety net to actually expedite the 10Q and 10K filing sign-off, in my opinion.
So does this put all the questions to bed at this point?
No, not necessarily, quite frankly. I mean, let's see what BDO says. I do think they're going to try to push along the filings as quickly as possible, possibly by year end. The deadline is sometime in late February, but I do think they'll try to push it along. Now, I will tell you, the other question is that was there so much reputation damaged because of this? Did they lose business?
So, assuming they can put this issue behind them, what is the story for this company here, Supermicro News? How do you position it within your tech stocks?
Yeah, look, Supermicro has been one of the hottest companies within the hardware industry. They were on the forefront or the poster child of AI servers, and you've seen a rapid rise in sales going from $1 billion or $3 billion in annual sales, and they were on track to about $26 to $30 billion in annual sales in fiscal 2025, right? And this is over a span of 4 years. Now, they didn't retract guidance, but they didn't affirm guidance either. Mm-hmm. So the question is that, look, what is the real sales going into fiscal 25? We do have a scenario analysis that in a draconian way, it's going to be $16 billion in sales, right? That's far off of the 26 on the low end, but it's still $16 billion in sales that Supermicro could deliver on the AI story alone.
And this is AI hardware, right, versus AI chips, for example, from NVIDIA, right? So a competitor would be like Dell, right? Like an AI
Dell,
server play.
Exactly.
So if I was a customer and I was like, you know what, Supermicro, I need to go somewhere else, is the only other option Dell, or are there other players out there?
Oh yeah, look, if we go back to last May at NVIDIA's conference, there were a host of AI server companies that were willing to partner with NVIDIA. So Supermicro is not the only game in town. Neither is Dell nor HPE. There are some Taiwanese ODMs that are more than happy to assemble AI servers out there. So we've seen because of the growing competitive pressure, we've seen margins compress as a result for the industry.
So they sacrifice, it feels like, the CFO here. How does the street feel about the rest of the management team, the leadership, as well as the board?
Well, look, the main issue in my mind was not only the CFO, but also the board. When you have the wife of the CEO as a member of the board and a 17-year-old person on the board who's been on for about 17 years, there's very limited independence. Quite frankly, I do think there needs to be some sort of overhaul of the board. And I've said in the past on this show, and I have written that I think the CEO may need to be promoted to a chairman role and may need a new CEO.
Now, what part of all of this has to do with just going from a company in the Russell to the company in the S&P and just growing super fast and having different kind of analyst coverage? And how much of this was going to come kind of no matter what?
Yeah, that's a good question, Alex. Look, this used to be a Russell company or a mid-cap company, and it was under the radar for a lot of analysts. And now we're talking about being in the S&P 500 index, and you're going to have a lot of magnifying glasses on the financials. And keep in mind, it's only been about 5 to 6 years back where they were delisted from the NASDAQ, and for them to do this again, it's quite frankly shameful in my mind. Now, if there is no wrongdoing here, shame on me, right? But, fool me once, shame on them. Fool me twice, shame on me. So, you're going to see a lot of scrutiny going forward. I don't know if they'll come back after this.
Have they lost customers to any material basis?
Nothing reported as of yet. What they said on the last earnings call was that there were a couple of customers who, they're trying to retain.
How much more, okay, so just pure valuation perspective, how do we know how to value this company when there are all these questions?
Look, at the end of the day, and Paul taught me well, it's all about cash flow and earnings.
Nice job,
and I don't know what earnings is. In our scenario model, we have $1.60 in earnings going forward. And hardware companies of this ilk, AI companies, are ranging anywhere between 10 to 15 times. So if my $1.60 is right and it's going at around, let's just say at the high end, 15 to 16 times, seems like from a valuation standpoint, it's trading at the fundamentals.
Our thanks to Jin Ho, Bloomberg Intelligence Senior Technology Analyst.
This week, we focused on a Bloomberg Big Take story titled A Roadmap Through the Drama and Realities of Trump's Trade War.
You can find it on Bloomberg.com and the terminal. The story looks at President-elect Donald Trump's proposed tariffs.
Everyone from Wall Street investors to foreign governments are trying to map out Trump's tariff plan in a fog of uncertainty, and Bloomberg Economics has mapped out a plausible scenario for what lies ahead.
For more on this, we were joined by Brendan Murray, Bloomberg Global Trade Editor.
We first asked Brendan to break down that latest research.
So if you add up all of the tariff threats that incoming President Trump made over the past week, about half the world's population of 8 billion people would be hit if you take the countries that he targeted. So there's a lot to unpack here. And so what we tried to do was separate the rhetoric, the late night social media posts from the more procedural approach that the Trump administration is going to have to take when it comes to rolling out tariffs. We talked to people who were in the previous Trump administration and supervised the last design of the tariff package, and we got a sense for how this next wave would be rolled out. So what we came up with, Bloomberg Economics crunched these numbers, and you're looking at 3 waves of tariffs starting in the summer of 2025, and by the end of it, at the end of 2026, the average tariff rate in the U.S. is going to go up by about triple. So from 3.5% to about 7 or 8%. So, and China is going to bear the brunt of that.
Do tariffs generate revenue for the U.S. government?
Yeah, they sure do. The customs revenue, the Treasury reports those once a month, and they would generate revenue for the U.S. government. Whether they'll generate enough to close the gap that tax cuts, extending tax cut, will create is a whole other question. You have to go back 100, 150 years to see when tariffs were actually a sizable part of the U.S. budget. At the moment, they're a tiny fraction of overall U.S. government revenue.
What I also find interesting in the piece, you guys talked about how the tariffs will mostly be on intermediate and capital goods. First of all, what does that mean specifically? And then what does that mean for, say, a small business versus me?
Yeah, those are not final consumer goods. Those are parts and machinery that go into the making of consumer goods. So the thinking there would be, number one, is that you could source those from another country other than China if the U.S. put tariffs on these capital and intermediate goods. So that would be the first consideration: is could you replace what you already get from China from somewhere else? And then the goal there would be to soften the inflationary impact that we pay at the store, at Target or Walmart or wherever we're shopping for consumer goods. That the goal would be to soften the inflationary impact. But there comes a time when you can only put tariffs on so many goods, and then you start to hit those products that we pay for as consumers.
What do most economists think the retaliation will be on the part of these governments? Because that's also a level of concern. How do we expect some of these foreign governments to respond?
Well, if you listen to President-elect Trump, he would say that, look, I threaten these tariffs against countries, and they come to the negotiating table when they give us what we want, fairness in trade, or in the case of Canada and Mexico over the past week, more border security to prevent the flow of fentanyl and illegal migration. So it's something other than just a way to collect revenue or to fix trade imbalances. It's to President Trump a way to exert foreign policy priorities as well.
Right, which makes it even more difficult to game out, right? Because you don't know how much of that is going to be just a strong arm to get other things, and how much of it is actually going to be implemented, and then what the retaliatory factor are. What's the level of conviction? When you were speaking to, say, Anna Wong of Bloomberg Economics and other peers in the area, what's everyone's conviction on their calls right now?
No one can make a call right now with any high level of confidence. There are, as we lay out in this Big Take story, there are just a lot of unknowns. How the degree to which the president-elect is threatening, rather as opposed to things that he'll follow through on. So this is what we call a plausible scenario. It's one that's based on the modeling that Bloomberg Economics does, the reporting that our Bloomberg News reporters have done, speaking speaking to people who were there for the first time and gaming out how it might happen the second time. So it's an attempt to describe the method that will come with a lot of the perceived madness of trade wars in the second Trump administration.
Our thanks to Brendan Murray, Bloomberg Global Trade Editor.
Coming up on the program, we'll break down earnings from software provider Salesforce.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the auto sector and Stellantis. Stellantis CEO Carlos Tavares recently resigned, and this has left the automaker without clear leadership at a time of significant upheaval in the industry.
For more, we were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst. We first asked Steve for his take on the most recent news.
Probably a bad timing for the CEO to make an exit at the moment. They are facing really tough market conditions, in Europe, in the U.S., and, to a certain extent, some emerging markets. So, Carlos he's been very good at controlling costs, and that's what we need at the moment to adjust to the current market condition.
So what's your read then on why now?
Well, I think, Carlos and the management team has done a lot. He's made some management changes to really bring down the inventory in the U.S. That's where the pain is. They typically get, adjusted operating income of double digits in the teens, but that's been down to single digit in the last quarter. So there's a lot of work to be done to actually bring down inventory in the U.S. so they can actually try to get some pricing on their new models that's coming out at the moment. So a lot of work to be done, but it's really out of his control at the moment. He's done all he can, Carlos, that is. It's really it's something he couldn't control. It's the market. Every automaker is facing a similar situation around the world.
And I think what we're seeing, I guess what I'm piecing together from reading your research and reading the Bloomberg News reporting here is, in kind of as it relates to the global auto industry, Europe's in a tough place because, again, like everybody else, they're not sure about this transition to EVs. Yet at the same time, China is flooding the market with electric vehicles, so it makes it even tougher for the incumbent manufacturers. Where are we in that process?
Yeah, I mean, it's an interesting industry right now to follow because there's all these dynamics. There's new competitor. It's becoming the 800-pound gorilla, China, which, it's coming into the market not just in Europe. They're thinking about coming into North America. We'll see how that goes with Trump in the office. But, EV is tough. A lot of countries in Europe have cut back subsidies for consumers. So, you hear Volkswagen closing plants, 2-3 plants in Europe. So it's going to take time to work out. I think we're going to see pain through 2025.
Where is the biggest pain point? Because you just listed off a lot of stuff. And when I think about car makers, I think, EVs, right? Like, it's not yet really profitable for these guys to make them, but you got to make them in order to make the prices lower and make them competitive and kind of put it out there and get the supply. Is that really the issue, in addition to Chinese competition, or a traditional auto landscape also struggling? When it comes to Stellantis, I should say.
That's a very good question. It's really not about EVs. EV only makes up less than 10% of a lot of these companies' annual sales. So it's not really EV. It's really the ICE vehicles that, during COVID, we had a lot of shortages because of the supply chain constraints. But over the past couple years, with that supply chain constraint going away, they've been producing a lot of vehicles, and they're refilling that inventory. And with higher interest rate over the last, past few quarters, you see that inventory piling up, and now they can't sell the cars, but at the same time they're going to have to drop prices, and the worry is it's going to spiral out of control, not only for Stellantis or Nissan, but for the rest of the auto industry. price cutting is not where the industry needs to go right now.
So talk to us about Stellantis, their brands in North America. How are they faring there?
Yeah, that's also a very good question. I think Carlos really had, the former CEO of Stellantis, really had a tough job. Not only does he need to manage the new market conditions that he's seeing in a lot of developed markets, but look, Stellantis is really an amalgamation of brands that a lot of automakers didn't want, right? I think, in the North American market, I think GM and Ford are probably more of the go-to brands. Third is the Asians, and then Stellantis is Jeep and Dodge and Chrysler. They're kind of they're famous brands, but it's not at the top of the consumer's wish list. And you can say the same thing over in Europe as well with Fiat.
Right, because I guess from what I hear, and this is, let's be clear, just a Matt Miller thing, you like trucks, right? Like, yes. Trucks is the thing. Like, pickup trucks is the thing.
Ram trucks.
Right. Those stuff. Does Stellantis, what's their market share in that arena?
Well, they still have, they're top three. They're third behind Ford and GM, Chevrolet. When they came out with the new redesigned Ram truck a few years ago, they did reach the number one market position in the U.S., but it has since then has fallen off, and their vehicles are getting old. Their pickup trucks needs a new redesign. Their SUVs are going through that process right now. They need to come out with new products to really excite the consumers.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
This week, Salesforce shares hit a record high after the company reported better than expected third quarter revenue.
This boosts hopes for the company's much hyped artificial intelligence strategy. For more, we are joined by Anurag Rana, Bloomberg Intelligence Technology Analyst.
We first asked Anurag what the street liked about recent Salesforce numbers.
I think when you really peel the numbers on sales and backlog, they were pretty much in line. But I think what is really happening, and something that we highlighted during a preview and some notes that we wrote, earlier in October, they released a new product called Agentforce, which is truly their AI product. Now, that's not going to drive revenue over the next 12 months, but it really changes the shape of the company and with the direction it's going in. And I think that's what investors are buying in right now, along with their steady margin expansion. Margins were so good. That has been a big story for them as well. So I think on all fronts, they're doing well. And as I said, the sales growth is not going to show up near term, but I think they have a clear strategy how they're going to play this game.
So to this point, if Salesforce is doing this well without Agentforce materially contributing to its bottom line, what kind of upside do we really have, and when do they reach sort of full tilt on that?
Yeah, I think I would agree with you on that because, people are buying into that without seeing the results. And I think this is truly what we have seen a lot in the software space is people really figure out which are the companies that will benefit in the long run. And a lot of that, you could say, value realization happens sooner, when the revenue realization is. So perhaps down the road, there'll be a time when the software space may not see a valuation uptick, but the sales growth will go up. But, one of the things you have to think about it from a Salesforce point of view, they have two really critical products. One is sales automation for salespeople, and the other is customer service products for customer service people. And in enterprises, AI is the biggest beneficiary to those customer service people. Chatbots, AI agents. We recently did a conference, and when we asked the question as to how many people use chatbots, it's still less than 20% at this point. So that is the direction where the world is going in terms of working with retailers, working with airlines, and these guys are right in the middle of it.
All right, so what's getting the market all excited here? This AI product. What is their AI product, and what is it supposed to do? Because I actually moderated a panel with the Salesforce executive, and I forgot everything he told me.
So think about it. I actually have a very interesting demonstration. If you go to YouTube and look at their Dreamforce demo, it was actually pretty interesting because they did Saks Fifth Avenue. So think about it this way, Paul. You buy, the presenter bought a jacket from Saks Fifth Avenue, didn't like the size or something, just went to the chatbot and say, can you find me a different size? And the chatbot basically took care of everything, basically knew what size this person was able to return the jacket, send another one to this person's address, or that matter, if it wasn't available, you could go to the store and pick it up without the intervention of a human. That level of sophistication coming into a chatbot so quick in the game, I think is really what people are getting excited about.
And put some numbers on that. Like, how much is that going to do for them in terms of revenue, and how much do they charge for like that chatbot? So say like that chatbot works for me for 2 minutes. What's the translation of money?
So the pricing starts at $2 per conversation. Now the question is, well, what does that mean? So when you look at, a person calling AT&T or Verizon, that call could cost as much as $10, $15. If it's a quasi mix of an automated chatbot and a customer service person, that call could be $7 or $8 per conversation. Salesforce is pricing at $2 or so. So it will force companies to fix their customer service, because think about it. If you're an insurance company, if you are a phone company, that's really a very large portion of your cost. Amazon's already doing so much of that in the chatbot. If you are used to returning things on Amazon through their chatbot, it's actually pretty impressive right now, but it is still rule-based, which is if it can only do so much based on the data that's available, it doesn't take you to the next level. And this is what Salesforce is saying is the direction of that is that the agent or the chatbot is able to execute a transaction for you without getting a human involved in it, which is refund some money for you, return your things, give you an alternative of whatever you were doing before without any person getting in, and that really saves costs.
All right, so this company's got like 39-40% EBITDA margin. Pretty much all of that goes down to the free cash flow line. What do they do with their cash?
Right now, they're buying back shares. I'm sorry, Paul, but that's exactly what most software companies do when they have it. Now, think about it this way. Just 1.5, 2 years ago, this was almost 10 percentage points lower because they were spending even more on sales and marketing. The big story for Salesforce in the last 1.5 years has been a real improvement in margins.
Our thanks to Anurag Rana, Bloomberg Intelligence technology analyst.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.